Welcome to the Deep Dive. Today we're tackling a question that's probably on the minds of many of you keeping an eye on the market. When we look at Coca-Cola and PepsiCo right now, which one might be the more compelling stock to consider?
Right. And our main source for this is a pretty recent piece from Motley Fool published just May 4th, 2025.
Okay, Motley Fool. For those maybe less familiar, can you give a quick rundown?
Sure. They're a financial guidance company. Been around quite a while, since 93 actually. Their whole mission is basically helping people get smarter about money.
And they reach a lot of people.
Yeah, millions. Through Fool.com, podcasts, you name it. So we're leaning on their analysis today.
Great. And as always, our goal here on the Deep Dive is really to distill what matters for you, the learner, when you're sizing up these two giants, as potential investments right now.
Exactly. At this specific moment.
So let's start with what they have in common. I mean, both Coca-Cola, PepsiCo, they're consumer staples producers, right?
That's the core, yeah. And what that means, practically speaking, well, they sell things people buy over and over again. Drinks, snacks.
Stuff you grab without too much thought.
Pretty much. The cost per item is usually pretty low, so it often comes down to, which brand you prefer, not a huge price decision. And importantly, a lot of these products feel like necessities almost, which gives them some stability, even if the economy gets shaky.
Right, which is why they often get called defensive investments. A bit safer, maybe.
That's the idea.
Yeah.
They tend to hold up relatively well.
Yeah.
And beyond that, they're both just massive global operations.
Huge global reach, yeah. I mean, their distribution networks must be incredible.
Absolutely. Super sophisticated distribution, massive marketing budgets, constant R&D to keep things fresh. Operationally, they're very strong, both of them.
Okay, and here's something the Motley Fool article jumps on right away, which I found really interesting. They're both Dividend Kings.
Yes, that's a big deal.
It sounds impressive. What does being a Dividend King actually tell us?
Well, it's a pretty exclusive club. It means a company has increased its dividend payout to shareholders every single year for at least 50 consecutive years.
50 years? Wow.
Yeah, half a century of dividend hikes. It just speaks volumes, about how strong and consistent their businesses are. They generate profits reliably, and they're committed to returning cash to shareholders.
Through thick and thin, presumably.
Exactly. It's a real badge of honor, signifies enduring success.
Okay, 50 years. That's definitely a powerful signal. So, key similarities. Consumer staples, global powerhouses, Dividend Kings. So where does the Motley Fool analysis start to separate them, for someone thinking about investing now?
Well, the article zooms in on the current dividend yield as a really key difference right now.
Okay.
So while they're both kings, the yield, which for you listening is just the annual dividend as a percentage of the stock price. I showed a pretty stark contrast in early May 2025.
How so?
For Coca-Cola, the yield was around 2.8%, which is interesting because historically speaking, that's actually near its lowest point over the last decade.
Okay, 2.8% for Coke, near a 10-year low. What about PepsiCo?
PepsiCo, the yield was closer to 4%. And what's really striking is that 4% is actually near the highest yield PepsiCo has offered historically.
Wow. Okay, that is a significant gap. 2.8% near a low, 4% near a high. So the article implies this yield difference might be telling us something about valuation, right? How the market sees them.
Precisely, yeah. The dividend yield can often be like a flag for valuation. A lower yield sometimes suggests the stock price is, relatively high compared to the dividend it pays out, maybe seen as more expensive.
And the higher yield.
Conversely, a higher yield can suggest the stock price is lower relative to the dividend, so potentially undervalued, or at least offering a better income return at that current price.
Okay, that makes sense. So did the Motley Fool article look at other valuation metrics to kind of back this up?
It did, yeah. They looked at the standard stuff. Price to sales, price to earnings, price to book value.
And what did they find?
For Coca-Cola, the article pointed out that all those ratios, PS, PE, PB, were actually trading above their 5-year averages.
Okay, higher than usual for Coke.
Right. But for PepsiCo, those same metrics were all below their 5-year averages.
That seems pretty clear then. Based on those common measures, PepsiCo looked, let's say, more attractively priced compared to its own recent past, while Coke looked a bit pricier.
That's the picture the article painted, yes. Which leads to the suggestion that for investors focused on value or on generating income, PepsiCo might look, well, more compelling right now.
But there's always a but, isn't there? I imagine there's a reason for that valuation difference. Did the article mention any challenges PepsiCo is facing?
Yes, absolutely.
Yeah.
That attractive valuation doesn't exist in a vacuum. The Motley Fool piece highlighted that PepsiCo's recent business performance overall hasn't quite matched Coca-Cola's.
Where specifically?
Mainly in their big snacking division, Frito-Lay, Quaker Oats. That part of the business is seeing some headwinds, softer consumer demand. And this actually caused them to revise their full-year financial forecasts for 2025 downwards when they reported Q1 earnings.
So that expected slowdown in snacks could be weighing on the stock price, hence the higher yield. Makes sense. A bit of a rough patch there. Did the article offer any thoughts on how PepsiCo might handle that?
It did. It made a point of saying that PepsiCo's management has a strong track record of adapting to market changes. They're not sitting still.
What are they doing?
They've been making strategic acquisitions. The article called them bolt-on deals. Basically buying smaller brands or companies that fit better with current consumer tastes, trying to refresh the portfolio.
Right. Actively trying to adjust to what people want now. That seems crucial in that industry. Okay, so what about Coca-Cola then? The article wasn't saying it's a bad investment, despite the higher valuation metrics.
No, not at all. They were clear on that. The article specifically said something like, there's nothing inherently wrong with Coke as an investment. The valuation might suggest it's fairly priced, maybe slightly expensive, but not wildly overvalued. So, for someone who values that iconic brand strength and maybe expects steady, if perhaps slower, growth, Coke could still absolutely be a solid choice.
Okay, let's try and pull this together for you, our listener. We started with these two consumer staples giants, both with amazing histories as Dividend Kings.
Right, 50-plus years of dividend growth for both.
But as of early May 2025, the Motley Fool analysis showed a real split in their current dividend yields. Coke was around 2.8%, near a decade low.
And PepsiCo was near 4%, close to a historic high for them.
And this yield difference seemed reflected in other valuation metrics, too.
Yeah, Coke's ratios like price to sales, price to earnings were above their recent averages, while PepsiCo's were below theirs.
Which, on the surface, makes PepsiCo look potentially more appealing right now, especially if you're focused on value or income.
But, and it's an important but, that lower valuation for PepsiCo comes alongside some current challenges, particularly in their snacks business, which led to lowered expectations for the year.
Though management is actively working on that, making acquisitions to adapt.
Exactly. And on the other side, Coca-Cola, while maybe looking a bit more expensive by some metrics, is still seen as a fundamentally strong, reliable company.
So the final thought here, drawing from this Motley Fool snapshot from early May 2025, really comes down to you, the learner, and your own investment goals. What are you prioritizing right now?
Is it income generation? Is it finding potential value? If those are high on your list, the article suggests PepsiCo warrants a closer look at this moment.
But you absolutely have to remember, this is just one analysis at one point in time. Things change fast in the market.
Definitely. Always do your own homework, your own research before making any decisions.
So thinking about your own situation, your own financial aims, which factors in this Coke versus Pepsi comparison resonate most strongly with you right now? That's something to mull over.